When the price of oil skyrockets, it's super easy to think the pain just stops at the gas pump, right? But that's just the first little tremor. A big spike in oil prices, it does way more than make your commute expensive. It sends this massive shockwave through the whole economy, and that creates a whole bunch of clear losers. So in this explainer, that's what we're going to do. We're going to follow that ripple effect all the way from the oil fields to your wallet and really see which industries get caught in the chaos. So, what really happens when oil prices go through the roof? I mean, it's so much more than just a number you see on the news. It's this whole chain reaction that puts the squeeze on businesses. It totally changes how you and I spend our money, and it can even, seriously, redefine entire industries. We're going to unravel that exact chain of events and figure out where are the weak spots? Where do things start to break? All right, here's the game plan. First up, we'll look at that initial shockwave and the kind of nerdy economic idea behind it. Then we're going to trace that very first ripple, and spoiler, it smacks right into the transportation sector. After that, we'll see how it gets bigger and hits your wallet. From there, we'll check out the huge impact on the auto industry. And to wrap it all up, we'll pull it all together into a sort of defensive guide for investors. Okay, let's get right into it. Section 1, the oil price shockwave. We are starting at ground zero here. The price spike itself and the big fundamental economic force it just unleashes on, well, everything. The big idea we need to get our heads around here is something called cost push inflation. It sounds complicated, but it's not. Just think of it as inflation that starts from the supply side of things. It happens when something absolutely critical, something you can't do without, suddenly gets way more expensive. And oil? It's the perfect textbook example. I mean, it's not just for your car. It's a key ingredient for plastics, fertilizers, even medicines. And it's the fuel that moves pretty much every physical thing on the planet. So you can see, when the price of oil goes up, the cost of making and moving everything goes up with it. And guess who ends up paying for it? Businesses have no choice but to pass those costs on to us. So what causes these massive price shocks anyway? Well, it can be a bunch of different things. You've got geopolitical conflicts, right? A perfect example is Russia's invasion of Ukraine, which just yanked millions of barrels off the global market practically overnight. Then there are supply chain disruptions. Think about a drone attack on a major pipeline in Saudi Arabia that creates instant shortages and a whole lot of panic. You also have these geographic choke points. The Strait of Hormuz is a big one. It's this super narrow waterway where something like a fifth of the entire world's oil has to pass through. So even a threat of it closing sends prices through the roof. And of course, you've got the big players like the OPEC Plus cartel making coordinated cuts to production. They can tighten the spigot whenever they want to push prices higher. Okay, so now let's follow that first ripple. This brings us to Section 2, Transportation's Turbulent Skies. And yeah, this is where we find the most direct, obvious victims of an oil price shock. We're talking about the industries that literally drink fuel to survive. Yeah, this quote really hits the nail on the head. For businesses like airlines and big shipping companies, fuel isn't just a cost. It's often the single biggest line item on their expense sheet. For a major airline, we're talking jet fuel making up like 20 to 30% of their entire budget. That's huge. So a sudden spike in oil prices, that's not just a minor headache for them. It's a legitimate existential threat to their ability to make any money at all. And you can really see the damage when you put these two scenarios side by side. Look, when oil prices are low and predictable, these companies are in a good spot. They can plan ahead, their costs are under control, and they can actually make a healthy profit. But when oil prices spike out of nowhere, those profit margins just get crushed. I mean, sometimes it gets so bad they're literally losing money on every single flight they operate or every container they ship. And all of a sudden, they have to start making tough choices. Jack up ticket prices, slap on fuel surcharges, cut routes that aren't making money, and in the absolute worst cases, they could even go bankrupt. Their entire financial stability is suddenly on the line. So, how do these guys fight back? Do they just sit there and take it? Well, no. A lot of them use a clever financial strategy called hedging. The easiest way to think about it is like buying insurance against crazy price spikes. An airline will pay a fee, a premium, for a contract that basically says, hey, we get to buy our fuel at a fixed price in the future. Let's say they lock in a price of $70 a barrel. Then, if the real market price suddenly rockets up to $100, they're protected. They still get to buy their fuel at that locked-in $70 price. It shields them from that insane cost increase and brings some much-needed stability to their business. All right, on to Section 3, the squeeze on your wallet. Now that ripple we've been talking about, it's getting bigger. It's moving away from the corporate world and landing smack dab in our daily lives. And trust me, it totally changes how we spend our money. This right here, this is the number that everybody feels. High prices at the pump or on your heating bill, it's basically like a tax that gets slapped on every single household. It directly eats into your disposable income, the money you have left over after you've paid for all the essentials. Just think about it for a second. If your family suddenly has to fork over an extra $100 a month just for gas, that's $1,200 a year. That's money that's not going into savings, it's not going towards a vacation, it's not helping you pay down debt. It's just gone. It's a direct drain on your financial health. So where does that extra money come from? I mean, you have to find it somewhere, right? Well, it gets pulled from what we call the consumer discretionary budget. That's just a fancy term for all the spending on stuff we want, but don't strictly need. We're talking about eating out, weekend trips, that new pair of shoes, going to the movies, all the fun stuff. Now, if you're an investor, this is a huge red flag, because when people's budgets get squeezed by things they have to buy, like gas, the businesses that sell all this discretionary stuff, they're the first ones to feel the pain when we all start to cut back. And this brings us perfectly to the next phase of this whole ripple effect. Section 4, automotive's engine trouble. See, when those high gas prices aren't just a fluke and they stick around for a while, people don't just spend less, they start to completely rethink what they're buying. This is a massive problem for the traditional car companies. All of a sudden, their main products, regular gasoline-powered cars and trucks, especially those big gas-guzzling SUVs, become way more expensive to own and operate every single day. That constant pain at the pump forces people to look at the whole car buying decision differently. It's not just about the upfront sticker price anymore, it's about the total cost to own that thing over the long haul. So now consumers are faced with this completely new trade-off. Sure, that traditional car might be cheaper to buy today, but the long-term agony of high, unpredictable gas prices makes owning it kind of stressful and expensive. And all of a sudden, that higher sticker price on an EV or a hybrid, it starts to look like a much, much smarter financial move over the life of the car. This change in how people think really hurts demand for regular cars and acts like a huge accelerator for the shift to electric. Which brings us to our final section, the investor's defensive guide. Let's put all these puzzle pieces together. Now that we understand how these ripples spread through the economy, how can an investor think defensively? How do you protect your money in this kind of environment? And maybe most importantly, what sectors should you just stay away from? This right here, it's such a powerful way to think about investing. A lot of times, winning isn't about finding that one in a million stock. It's just about successfully avoiding the obvious losers. Just knowing where the landmines are is the first step to making it through. And by tracing this ripple effect, we already pointed out a few industries that are heading straight into some serious, predictable headwinds when oil prices are high. And this all feeds into this great idea called a circle of competence. All it means is you should focus your investments on the things you genuinely understand. Knowing, for example, that airlines that don't hedge their fuel costs are going to get crushed, or that restaurant chains will probably see fewer customers, that is building your competence. It gives you an edge. It lets you see the specific risks that these companies are facing and helps you deliberately sidestep those predictable losers. Then you can focus your attention on businesses that are built to be more resilient. And all this leaves us with one last big question to think about. As we keep moving towards an electric future with EVs and renewable energy, will these oil price shocks just become a thing of the past, something we read about in history books? Or are we just trading one set of problems for a totally new one? Will the economic shocks of the future be caused not by a ship stuck in a canal, but maybe by a shortage of lithium for batteries, or a massive cyber attack on the power grid, or maybe some other weak spot we haven't even thought of yet?